We're going to keep the conversation going with our next guest, who is expecting consumer strength, but he does question whether retail stocks will see the big benefits from it. Dan Suzuki is the Deputy Chief Investment Officer at Richard Bernstein Advisors. Thank you very much for being here with us, Dan. Talk us through where you see the consumer and how you believe that will or will not play into the retail stocks.
Well, thanks, Courtney. I'd say I'm pretty mixed on the group overall. I mean, at RBA, we tend to look at profits, liquidity, sentiment. I think there's some good things and some bad things overall. As everybody mentioned, consumers still got a lot of money to spend, and they probably will spend it as we head into the holiday season. So the numbers that these companies are going to put up are probably going to be pretty good. But as everybody's focused on supply chain issues and the ability to have pricing power, pricing power tends to go further up the supply chain. So obviously, as consumer-focused companies, they're going to be at the end of the supply chain, and they're not going to have as much supply chain pressure. Meanwhile, they're also the most labor-intensive, so have to deal with those labor shortages that we're dealing with right now. Meanwhile, from a liquidity perspective, there's one sector that sticks out that tends to underperform as the Fed is tightening, particularly as they start to raise rates, which potentially could come as early as next year, is consumer discretionary sector. And meanwhile, despite all of those dynamics, it's one of the most expensive sectors out there. So I think there's just better ways to get cheaper growth if you're bullish on growth here, which we are.
Hey, Dan, when you look at the whole rates dynamic, I'm glad you brought that in. How much does that play into what your bets are? You're leaning a little more cyclical in what you think of to be the next growth, quote unquote, environment to be. Are you perplexed with the 10-year and why rates aren't really acting the way you would think they would?
Yeah, Steve, I am a bit perplexed, to be honest. I mean, I think if you look at the longer term trend since rates bottomed, it's actually been in a pretty steady upward trend. As soon as it gets a little bit ahead of itself, you start to see, that downward pressure on rates. But we're right in sort of that long term trend. If you were to have, one of the technical analysts on the show, they'd probably tell you we're sort of in this nice little trend channel, and that's very supportive of further moves higher in rates. So I think that the reality is the Fed has cornered the market on treasuries. They own over 50% of the 10 to 20-year maturities. So as they start to buy less, that support's going to come out. So I think that especially in the environment where growth we think is going to still be pretty good here, that should continue to send rates higher. And so that's where we're positioned in the book.
Dan, what are your thoughts right now on inflation, where it's the hottest? Is it transitory? Is it not? And then the follow through there for some of your recommendations if you're looking at sectors.
Yeah, I mean, the whole inflation story, I think the transitory debate is dead, right? I mean, I don't know why even the Fed itself has admitted that it's no longer, it's not transitory. So I don't think that's a debate, and I think it's here to stay. And I think that, the headline numbers could eventually start to come down, toward the low threes. But I think if you step back, the underlying trend on inflation is still higher. I mean, you still have the ongoing, supply chain issues. I mean, you've been reporting on CNBC all day, the number of ships outside of the, Long Beach, LA ports is basically continues to go higher. So that sort of temporary part of the story hasn't abated yet. Meanwhile, the longer term story, the bigger part of the CPI components that is the shelter component. That's a big chunk of what we spend on. That's going to continue to move higher. And then put those aside, all the macro forces suggest that inflation is probably going to tend to trend higher, if only because the economy is tighter than it was a few years ago before the pandemic even hit. And so I think that you want to still position for higher inflation. And I think that's one of the reasons that we're overweight energy in our portfolios, is because I think that's a great way to get that inflation hedge in the portfolio, especially at the cheaper valuations and a good dividend.
Got it. Dan Suzuki, thank you for joining us here tonight.
Thanks, guys.
Tim, I want to toss it over to you. What do you make about the thoughts on energy as a good way to play inflation being permanent, not transitory?
Look, I think we still have this reflation trade going on. So if we think rates are slowly moving higher, even if Steve and Dan are perplexed. I mean, I think you've got a case here where a lot of things, a lot of hard assets are moving higher. So I think the dollar is something to be concerned about here. I just think that the supply-demand imbalances and the lack of swing capacity in any place other than OPEC right now, and as long as they stay committed with OPEC Plus, they're going to have the ability to hold prices up here. And right now, I think there is a little bit more political gamesmanship in here. I think energy stocks look great. I've been long oil services. I've been long integrateds. And I do think that the oil services names, every day that oil stays up here, there is more and more drilling going on. So it's not been a linear follow through with the oil price. It's underperformed, maybe for a reason to this point. Rig counts have more than doubled from the last 12 months. So like oil services.
We're following a developing story here out of the White House. President Biden is about to kick off a high-stakes meeting with Chinese President Xi Jinping. CNBC senior White House correspondent Kayla Tausche is live for us with the latest. Kayla, what's going on? What do we know now?
Courtney, President Biden is expected to hold that virtual bilateral summit with China's President Xi Jinping at 7:45 Eastern Time. This is the closest thing to the first face-to-face meeting that the two leaders will have under the Biden presidency. Don't expect any specific deliverables to come out of this. The senior administration officials said that President Biden initiated this meeting specifically for the reason to make sure that Beijing understood that the U.S. wanted to avoid confrontation, even as it challenged China's behavior on the world stage. Among the areas where Biden will raise concerns, Taiwan, technology, and human rights. But the president wants to erect guardrails around those issues and also seek cooperation on other areas like climate change and trade. Although the senior administration officials said do not expect the U.S. to raise issues on tariffs or on the supply chain. This meeting is expected to last several hours into the evening, and the press secretary said today that there should be more information provided by the White House at its conclusion. But interestingly, the timing of the meeting is no coincidence. Earlier today, you saw President Biden sign the $1.2 trillion bipartisan infrastructure deal into law. The president's foreign policy since the campaign trail has been rooted in projecting from a position of domestic strength outward for these conversations with global partners. Passing this bill and signing it into law and initiating perhaps $1 trillion of investment into this country, even over a number of years, is something that the president is expected to laud in this evening's conversation and show China that it plans to challenge it here at home. Back to you.
Kayla, thank you very much. I know you're going to be following that for us. Guy, what are you watching out of this call? Seems like it could go a lot of directions, but nothing with the tariffs, nothing with trade of any real substance?
I'm watching I want not the call itself, but then the subsequent commentary post-call and see. Like one of my concerns, and by the way, unfounded concerns, has been what's going to happen with China, this China-Taiwan situation, which seems to be getting, I don't want to say worse by the day, but the rhetoric clearly hasn't gotten any better. Do we have any, let's say, do we have any cooling there in terms of some of the rhetoric? That would be very bullish for the market. I just don't think it's going to happen. And I guess my point is, I think the market's underestimating how poorly things can go in this continued tension between China and Taiwan.